Welcome to Growth Investing Mastery. This video will look at my March 2026 growth stock portfolio review. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to review my growth stock portfolio at the end of March. We'll take a look at company updates and my decisions over the course of the month. I have a goal of finding the most compelling growth stocks at any given time, and I allocate a concentrated portfolio based on my conviction level. I also wanted to give a quick update on our production quality. I figured out a way to make the images higher resolution, so the text should be easier to read from here on out. Jumping into my current allocations, I have 5 high confidence positions. The first is AppLovin with 16.2%. That's followed by Astera Labs at 13.8%. Next we have Iren at 11.9%, FIGR Technology at 11.4%, and Credo at 11.1%. We have 4 medium confidence positions as well, the first being Reddit at 8.5%, and then XTI Aerospace at 6.1%. That's followed by Micron at 5.5%, and Pattern Group at 4.9%. Then we have 3 medium or lower confidence positions. These include Electrovaya at 4.2%, Ethos Technologies at 4%, and Nebius at 2.5%. The structure of my portfolio has flattened out a bit since previous updates. What I mean is I used to have a few positions that were slightly above 20%, and now my highest allocation is at 16.2%. This is partly because I wanted an increase in FIGR Technology and Credo. I was also looking to get the number of positions down as I look to concentrate in my highest confidence positions. Let's now take a look at our portfolio changes on the month. We added to Credo, FIGR Technology, Reddit, XTI Aerospace, and Micron. I trimmed AppLovin some because the allocation got pretty high compared to the rest of my positions. And I trimmed a little bit of Astera Labs to put in Credo because I really like the numbers on Credo's last report. We have one new company in the month called Ethos Technologies. And I sold Dave Inc., BioHarvest Sciences, and Accelerant Holdings. We also bought 4 companies in the month where we later changed our mind on them. These companies that we bought and sold were QTI Imaging, FIGS Inc., Sandisk, and Applied Optoelectronics. And we'll discuss those 4 names that were bought and sold towards the end of the video. Let's now take a look at our results. Reviewing our yearly results, in 2024, my portfolio was up 146%, and in 2025, my portfolio was up 112%. However, in 2026, we're down 20% year to date. But the cumulative return is plus 317% since the start of 2024. If you've been following the channel for a while, you may have noticed we don't have the graph here right now. The reason for that is my main account had an overweight balance versus the other brokerages that I have. I really wanted to maintain showing a graph for as long as possible, but practically it made sense for myself to balance out my accounts a bit more. So it didn't make sense to keep showing the graph in this scenario. What I've decided to show instead is the year-to-date point in time. I know some other growth investors who like tracking this point in time as they go through the year. And this shows where the results were at the end of each month for the year-to-date returns. So at the end of January of 2026, we were up 4% year-to-date. And then there was a pretty hard downswing in February where we ended February down 16% year-to-date. Then currently as of March 31st, we're down 20% year-to-date. One thing to keep in mind is we're still early in the year, so there's a potential to catch up on returns for the remainder of the year. And back in 2025, we were also down over 20% in mid-April, but still managed to end up over 100% at the end of the year. Let's now take a look at our market and portfolio commentary on the month. We're using these challenging market conditions to concentrate in my top conviction stocks. And we want to be cautious about overthinking and second-guessing companies. It's important not to complicate or change our strategy significantly right now. The market has stopped rewarding accelerating fundamentals in favor of new narratives. We've seen this in a few different spots where the market is having overreactions to the copper versus optical debate, and it seems like it's all or nothing thinking from the market. We also saw a market overreaction to Google's turbo quant development, and that impacted memory related stocks a lot. We've seen past cases where the market reacted in a similar fashion to new tech. Some older examples include the dot-com stocks from the 2000s, blockchain from 2018, and biotech from 2020 with COVID. Here's an example. Kodak in 2018 announced they are working on a blockchain solution, and the stock goes from $4 to $12 in a single day. But the blockchain solution never translates to actual revenue and income. And Kodak falls back to earth over time as the hype did not generate revenue or profitability. With our strategy, the strong underlying fundamentals of the business give us downside protection. The market always catches up to accelerating financials at some point, but it might take an extra quarter for the market to recognize the strong results. Or if it's a really strong bear market, it might take more than a few quarters for the market to catch up with the fundamentals. And with our strategy, we're not completely reliant on the market maintaining enthusiasm for the company's story. Now let's jump into the individual companies. Our highest allocation company is AppLovin with symbol App. They're an ad tech platform for mobile games and e-commerce. Recently, the Oppenheimer Investment Group released a note saying many e-commerce brands are unaware of AppLovin's Axon engine, but their research concluded that these companies are open to using it. And Oppenheimer mentioned the incremental nature of AppLovin's audience. On AppLovin's Axon blog, they said gaming has evolved into a true mass-reach consumer channel. And their research shows that mobile gamers are influential household decision makers. One meaningful bit of news in the month was AppLovin's partnership with Stagwell, which is a global marketing and advertising network. Stagwell did $2.9 billion of revenue last year. The partnership brings Axon's capabilities to Stagwell's client base. And the Stagwell CEO said it's a natural fit for the firm's broader focus on AI-powered marketing. A few key takeaways for myself is that I will be interested to see how the return on ad spend, or ROAS, evolves as the platform gains scale. And my initial take on the e-commerce platform is that the ROAS for AppLovin is at least as good as Meta, with an incremental audience. By incremental, we mean that AppLovin's audience does not have a lot of overlap with Meta's audience. On the e-commerce platform, management mentions they are working out last-minute onboarding issues before a more general launch. And I'm expecting the GA launch to happen at the end of Q2, but the company might be a quarter behind their initial launch plan. I seem to remember last year that management mentioned that general availability would launch sometime in early 2026. But it makes sense to me that they want to get the product near perfect and integrate the feedback they're getting from their customers first. I trimmed my allocation in AppLovin a little bit because the allocation got well ahead of all my other stocks, and many of my other stocks got quite beat up recently. Our next company is Astera Labs with symbol ALAB. Their product is next-gen AI networking infrastructure. The company was recently at the Roth conference, and they detailed how hyperscalers are building internal solutions that have different characteristics. The company is looking to enable their Scorpio switch for optical engines. They also detailed at the conference how the Taurus product line is led by Amazon on a variety of different platforms. When discussing optical, the company said it's expensive, less reliable, and more power hungry than copper currently. But Astera has optical solutions in the works as well, including their AI X-Scale acquisition. One interesting detail on these optical solutions is Astera said they have a large customer qualifying just the standalone discrete glass coupling piece. And they added this could hopefully drive some volume starting next year as well. The company's Aries product line is growing 70% year over year, but coming down on a total revenue percentage as other product lines are growing faster currently. There's a 20% uplift in the Aries average selling price going from Gen 5 to Gen 6. One critique I've seen of Astera is that their Aries product line was more useful for Hopper or Blackwell systems rather than Vera Rubin. Recently, when I was listening to a podcast with Dylan Patel from Semi-Analysis, he mentioned that a Hopper machine is worth more than it was 3 years ago. That was a really surprising detail to me, because it somewhat counters the narrative that upgrade cycles will make the older systems instantly obsolete. So it sounds like the Hopper systems may be around for a while. And that's pretty good news for the Aries product line, which deals a lot with the Hopper systems. The Aries product line also is used in custom ASICs by hyperscalers. A few takeaways on Astera Labs. When we compare to other hardware providers, Astera Labs has custom silicon designs with a software component, and this gets them a lot higher margins than competitors at 76% gross margins. And this is a prime example of a company where we don't want to second guess the narrative right now. The financials are still showing strong at 92% year-over-year revenue growth. When we compare to a peer or competitor in the space with Credo, it's important to know that there's different product timelines than Credo, although Credo is growing faster with revenue growth. So I did trim a small amount of Astera to place in Credo based on following the numbers. The next company I own is Iren with symbol IREN. They are a neo cloud for high performance compute. The company's earnings in early February projected $3.4 billion of ARR as a run rate by the year end. There was a combination of press releases in early March which had a big impact on the stock price. On March 4th, the company announced they acquired 50,000 NVIDIA B300s for a total of 150,000 machines. They said this ups their projected run rate to $3.7 billion of ARR by the end of the year. However, on March 5th, the company announced they're raising $6 billion through ordinary shares, and that incurs significant dilution to shareholders. The market did not like this announcement of a new capital raise. And a few takeaways for myself are it would have been ideal to have announced a new hyperscaler deal along with the capital raise if it was possible. Management has mentioned there are multiple potential deals that are in progress being negotiated right now. And I would like to see a deal announced soon, as it has been over a month and a half since their last earnings call. One thing to keep in mind is the next earnings report numbers may not impress, as the Bitcoin price has been tanking during the quarter. The company still has a Bitcoin mining operation that's ongoing. And while they have some of the best unit economics in the Bitcoin mining business, the price of Bitcoin went down dramatically enough to impact the revenue numbers significantly for the next quarter. Although I didn't check how the Bitcoin mining difficulty adjusted since the price went down. And that's one factor in Iren's favor for their Bitcoin mining that other miners may have taken their machines offline. For the next earnings, ideally the market will focus on ARR targets for their high-performance compute and potential announced deals. But with the current market conditions, there's a chance the market focuses on the top-line number only. The next company I own is FIGR Technology, with symbol FIGR. They're a blockchain marketplace for tokenizing real-world assets. The company recently presented at the Cantor Fitzgerald Tech Conference. At this conference, the company cited Larry Fink, the CEO of BlackRock, saying that every asset will trade on blockchain at some point. And BlackRock has been a big proponent of the solutions that FIGR is proposing. The solutions that FIGR has offer a better settlement rail, less third-party review needed, and transactional and liquidity efficiencies. Reports can be created in real time with up-to-date info on different loans. Recently, multiple companies have failed by double pledging. Two of these companies were Tricolor and First Brands, and their businesses had to shut down after that. Goldman Sachs is the warehouse lender to FIGR, and Goldman can look up loans on the digital loan registry. This acts as a virtual padlock for the loan. At this tech conference, FIGR talked about their on-chain stock market. They also had a critique of the approach that Robinhood is proposing, which is a synthetic derivative. The company gave details of their advantages for their native blockchain stock market. They said you could even pay somebody with a share of a company as a thank you, assuming you're KYC'd already. And FIGR is the purest version of a blockchain stock market. You can hold the shares in your own wallet. The company discussed a tremendous outreach to FIGR from fintechs and crypto companies that want relationships with FIGR. FIGR Connect offers easy onboarding, and joining the marketplace gets access to all the investors that have already been onboarded there. They give originators the ability to maximize their gain on sale. At this conference, the company mentioned doing $0.5 billion of securitization last week that cleared the market, and they said the market is super strong. There was 5,000 loans in these deals, and they said they expect a flight to quality on our side. Money will go where safety is, they said, and they added, "We think we are safe." Let's continue on looking at some more details of the Cantor Fitzgerald conference for FIGR. The company's democratized Prime platform enables DeFi liquidity to fund warehouses. This offers people the ability to compete with warehouse lending. They offer real-world assets at a reasonable yield. And one direct quote is they said, "You're going to get interest." They can do pledging as a service. For the originator, this is an a la carte style, meaning you can take what you want. The stable coins will be the payment rail for the ecosystem. This facilitates the selling of loans. Exchange buyers give the Yields token and can trade in and out. Yields is also a security that pays interest, and it went through the traditional S1 process. This means they file 10Ks and 10Qs for the proper regulations. Additionally, it's a tokenized money market, and you can trade peer-to-peer as well. The stablecoin solves tons of pain points, including cross-border payments and atomic settlement in real time. The rights of a contract and the stable coins transact together in smart contracts. In this conference, they contrasted that with wire transfers, and they called these wire transfer transactions trust me type stuff. This is because with the wire transfers, somebody always has to send first, and they're at risk of getting scammed. FIGR recently announced a partnership with Agora, which is for car loans, and it seems like a pretty important partnership. It's the first third-party borrower coming onto the Connect platform, and they said there are more coming. Stay tuned. The management detailed they are targeting large TAM markets. These include the $2 trillion mortgage market, the $1.5 trillion auto market, and they added they're not fighting for a piece of the pie here. First lien mortgages make up 19% of the mortgage loans for FIGR, and this is up from 12% from last year. The company can do small balance home equity lines of credit, and those traditionally are not worth the time for bigger lenders. That's also because the cost for traditional lenders is a lot more to originate these small types of loans. The company detailed that an AI loan officer was 2 times as efficient. They don't have underwriters, and the process is automated. Lastly, one thing I learned about their yield stablecoins is the yields balance can fluctuate up and down. By balance, I mean the total tokens in circulation. There's also a site called yields.com. It's spelled YLDS.com. And this site seems to update every few days with the total number of coins in circulation. I did notice there was a huge ramp up and then a steady drain down over the course of the month. So they probably onboarded a lot of loans at once and then are doing transactions with those. But overall, I found the story checks out of the yields in circulation going up and down. The next company I have is Credo with symbol CRDO. They are a next-gen AI networking infrastructure manufacturer, and they have both optical and copper solutions. The stock has been selling off pretty hard, and this is surprising given the incredibly strong report they posted. On their earnings call in early March, I was looking for them to guide to at least $425 million of revenue for the next quarter, which I thought would be a strong number. Prior to the report, the company had given a cautious note in their pre-announced revenue number. But I did have some concern they may guide flat in terms of their projected revenue for their upcoming guidance. I had the earnings date wrong on my calendar, and I noticed the stock was tanking, and that the company had just reported earnings. Before I saw the company's press release, I already saw an article saying the company was down because of their poor guidance. And my thought was, oh no, they must have guided for a number like 370 or 380. But it turns out they guided for 425 to 435 million next quarter, which is above my optimistic expectation. Just landing at 435 million would be plus 156% year over year, and the company has historically beat their guidance by a lot. Speaking on competition, the company said our zero flap AECs deliver up to 1000x better reliability than commodity-based laser optics, while consuming roughly half the power. In their earnings report, they also talked about the inherent link flap instability of commodity laser-based transceivers. They detailed that our zero flap optics were designed to address these challenges directly. Later in mid-March, the company announced 3 new optical solutions in separate press releases. My quick take was these all sounded like really innovative products. Yet the company seems to get zero credit from the market for their optical solutions. There's been a lot of days recently where optical providers were all up over 10%, and I saw Credo was down. It just seems like the market is totally unaware that Credo has innovative optical solutions. These are already in production, as well as they've detailed that Oracle is using a lot of these optical solutions. And it sounds to me like their optical products offer innovations beyond the competition in terms of reliability. The next company I own is Reddit with symbol RDDT. They're a medium confidence position that I've owned for a while now. Their product is a community-based social media platform. I had a recent thought that Reddit is a one-of-a-kind in social media. Much of their code is actually open source, but the value is in the communities that gather on Reddit. I thought their most recent quarter was a decent report, but the market doesn't seem to understand the business has seasonality, especially in Q1 after the holiday season. The good news is that revenue will accelerate throughout the year because of the seasonality. I did think that management could do a better job setting expectations on the seasonality in their business. The market has tanked the stock both times going from Q4 to Q1 since the company's been public in their 2-year span. And this was based on their guidance, where the guidance was down sequentially going from Q4 to Q1. Reddit recently announced a new partnership and integration with Shopify. The partnership is in alpha, but it sounds like a promising integration. Additionally, I saw there was a March 2026 report that Reddit is working to renegotiate data licensing deals they have. They're potentially switching from fixed to dynamic-based pricing with their deal with Google. Previously, I had been critical of the data licensing deals because about a year ago, they saw a huge ramp up, but then that revenue just hit a wall and stayed flat. Overall, my take is the increasing profitability of this business makes the stock price look attractive now. The trend for net income over the last few quarters has been really impressive. It goes from 26 million to 89 to 163 and then to 252 million of net income in their latest quarter. The company has a trailing PE of 51 and a forward PE of 20. I decided not to use the run rate PE here, which I typically like. And this is because Q4 is the strongest for the holiday season, so I don't want to extrapolate that out for 4 quarters. I added to Reddit during the month because I like the price now, and I like the prospects for this business. My next position is XTI Aerospace with symbol XTIA. They are a drone producer and distributor, and the company's acquisition of Drone Nerds provides a huge projected revenue boost. The company currently has a $70 million market cap, but they're expected to get $163 million of revenue in 2026 from analyst projections. I put a screen capture of what analysts are expecting on the right side on the infographic here. It shows the first quarter of 2026 is projected at $33 million of revenue. That's followed in Q2 by $41 million, $43 million, and then in Q4, $46 million. For the full year, the company itself gave a guidance of $160 million of revenue. The Drone Nerds side of the business is growing rapidly, and their business model is somewhat similar to Dell, but for drones. They assemble different drones and parts and components from different vendors and sell to a variety of different customers. The company is flying under the radar, pun intended there. This is because the acquisition details are in their filings right now. There's been a really high volatility in the stock price over the past month. It's gone from about $1.60 all the way up to over $3, and then back closer to $2 currently. Getting into some more details of the Drone Nerds business, the company is already GAAP profitable, and filings showed margins of 23%. For the 9 months ending September 2025 for Drone Nerds, they had $80 million of revenue with $8 million of net income. But we want to keep in mind the legacy eVTOL business is not profitable yet for XTI. This is their electric aircraft, which they're still working on. There's only 2 analysts that cover XTI Aerospace, but they have price targets of $5 and $10. Normally, I don't place a lot of weight on price targets from analysts, but this is pretty encouraging to see that both price targets are well above the current price. The company's earnings report in May will be the first combined earnings as the company is working through the accounting. Management mentioned there will be an emphasis on growing the Drone Nerd side of the business, but they're planning to continue R&D on the eVTOL side of the business as well. I'll be interested to see where the profitability lands once the two businesses are combined together. I'm expecting this company to get more attention from the market once the numbers land coming up. My next company is Micron with symbol MU. They are a memory maker that's expanding their scale. The company had a really impressive earnings. Revenue was guided for $18.7 billion, and it landed at $23.9 billion. This is up 196% year over year and 75% quarter over quarter. Before reporting, analysts were expecting a guide of $24.6 billion for the next quarter, but management guided all the way to $33.5 billion. Gross margin in the latest quarter was guided for 68%, and it landed all the way at 74.4%, a massive beat. Even more shocking, the next quarter is guided all the way up to 81% for gross margin. That's a higher gross margin than NVIDIA has now, and it's on par with many SaaS companies. Management said DRAM, NAND, and high bandwidth memory all reached new highs for sales. And AI's evolution makes newer architectures require more memory. The company expects NAND and DRAM supply conditions to remain tight beyond calendar 2026. The company increased its projected CapEx for fiscal 2026 to over $25 billion. This is up from an estimated $20 billion that they were expecting in the prior quarter when they were projecting out CapEx. And Micron's fiscal calendar works that there's currently 2 quarters left in fiscal 2026. Adjusted EPS in the quarter was $12.20, up a stunning 682% year over year, and up 155% quarter over quarter. Next quarter EPS is guided to $19.15. On the call, they detailed how many customers were only able to fulfill 50 to 66% of their demand. They also detailed how next generation systems such as NVIDIA's Vera Rubin, uses a tremendous amount of HBM and DRAM. And management detailed how memory is a strategic asset. AI cannot scale up without it. On the NAND side of the business, one direct quote was, "Our portfolio is incredibly well positioned to continue to gain share." My overall take on Micron is they have impressive pricing leverage within the marketplace. I was surprised to see the stock trading down heavily after earnings. In a normal market, this stock would have gotten a big rally. But it seems like there's market concern on cyclicality and the new Google algorithm. My take here is that both of these concerns are overblown. Because of this, I added slightly to my position in Micron during the month. Another medium confidence position in my portfolio is Pattern Group with symbol PTRN. They're a brand accelerator handling inventory and logistics. The company reported earnings in early March with a strong result. Revenue in the quarter had been guided from $680 million to $700 million, and it landed at $723 million, which was up 40% year over year. On profitability, the company had guided adjusted EBITDA from $38 million to $40 million. This came in at $43 million, which was up 59% year over year. Net income landed at $29 million, and that was up 58% year over year. From my perspective, it's encouraging to see profitability growing faster than revenue for this type of business. It likely means there's some type of upsales going on for their customers. The company had a record NRR number of 124%, and that's up from 116% last year. Management said this is the most important metric for their business. Non-Amazon-based revenue was $61 million. This is up 94% year over year, and non-Amazon revenue now makes up 16% of total revenue. So it's still a bit of a risk for this business that they're so dependent on the Amazon platform. However, this is a really significant improvement in the non-Amazon revenue because non-Amazon was just 7% of revenue last quarter. The company's next quarter guidance for revenue is from $710 to $720 million. Adjusted EBITDA is projected from $41 to $42 million next quarter. And there's likely significant seasonality with this business as they just reported Q4, and this company is a brand accelerator. So I thought that was pretty decent guidance that they're guiding for the run rate of Q4 revenue in Q1. Because the holiday season is over now and Q1 is likely to be weaker seasonally. On the earnings call, full year guidance was given as well from $3.12 billion to $3.14 billion. And those numbers imply $790 million of average quarters per the year. The company announced a share buyback program as well. The most interesting piece of information from the earnings call, from my perspective, was on their SaaS services and logistics. They said this part of the business grew 58% for the full year and an impressive 162% in Q4. And another quote was, "There's a continued expansion into higher margin offerings." This gives the potential for the stock to be re-rated at some point. They are currently categorized as broadline retail, but if the market starts thinking of this company as a technology play, the stock price could go up a lot. I was looking into the company's different SaaS and logistics products, and it seems like an impressive set of tools. There was a wide range of insights-based tools, AI generative and optimization tools, and also content creator management tools. The next company in my portfolio is Electrovaya with symbol ELVA. They make performant lithium-ion batteries with an enhanced safety profile. The company recently received a new certification called UL 2580. And the certification applies to their high-voltage battery systems that they make. It involves the most stringent testing for fire propagation, vibration, mechanical shock, and short circuits. And the certification is a commercial requirement for some fleet operators and OEM integrations. Electrovaya is a high-voltage first mover in this category, and it's the first of their kind in this segment. On March 5th, the company held a special call detailing more aspects of their business. They said they're powering 16 of the Fortune 100 companies and a much larger number of Fortune 500 companies. On their Jamestown expansion in New York, they said everything is moving quite well. Another direct quote was they said a lot of activity is happening right now at the site. The current phase of the Jamestown expansion is bringing in an additional 150 to 200 million of revenue for the annual run rate. Currently, the company's Canadian infrastructure and manufacturing can provide 100 million of revenue for their run rate. I had previously thought that Jamestown was a 3x capacity increase over Canada. Or it's possible I heard that and they said they're going to triple their capacity. But what they detailed in this call is there's continued room for expansion on the site. They own 52 acres and progress is in phases. So it sounds like they can continue to build out as they see increased demand for their product. And previously the company had detailed they're reaching capacity constraints in Canada because they're seeing more demand than they can handle. On the subject of robotics, the company said robotics is happening now, and we expect that to be a high pace of growth going forward. However, I did trim my position significantly after their most recent earnings release. The top-line revenue number came in lower than my expectations, but I still want to see what happens next with this business as their progress with the new facility continues. One new company that I bought this month is called Ethos Technologies, with symbol LIFE. They are a life insurance platform for agents, consumers, and carriers, and they are disrupting the legacy life insurance business model. I had a detailed write-up in the YouTube post section about a week ago, and I'll put a link to that in the description in case you missed it. One thing that makes Ethos different from other life insurance companies is they hold no loans on their books. This means they have less risk, and they also have a 98% gross margin with strong profitability numbers. One more detail that we learned since our post is that Ethos earns about $2,000 commission per policy sold. The last company I own is Nebius with symbol NBIS. They are a neo cloud with an emerging software platform. And recently the company signed a new deal with Meta for up to 27 billion of total potentiality over 5 years. There's 12 billion of dedicated capacity across different locations, and additional optionality of up to 15 billion, which makes for the 27 billion total. However, management added their guidance remains unchanged for 2026. So it seems like the team was well aware that this deal may close soon when they created their guidance. The stock shot up about 15% on the news of the Meta deal. But then the following day, it gave back all those gains after announcing a new corresponding capital raise. Lately, the market seems to not like capital raises from the neoclouds, whether it's Nebius or Iren making those capital raises. I would have preferred to see some of the funding come from paring down their VC investment stakes. The company has a whole lot of different side bets they're making in startups, and I feel like that's a distraction from their main business. For example, they own 25% of ClickHouse, and that stake is worth about $4.2 billion. It's a real-time analytics and database company. They also own 83% of AV Ride, with their stake there said to be worth $2.3 billion. That's an autonomous vehicle and robo-taxi company. And I feel like to do my due diligence properly on Nebius, I should probably be checking in more on what these side bets are doing. But it's probably tricky for Nebius to exit these positions as they're not public yet. And it would be challenging to sell these private stakes in such large amounts. More generally on the funding rounds, I'm okay with Nebius raising capital like this, as the terms are pretty cheap and the capital seems freely available right now. That might not be the case later if credit conditions tighten, so it makes sense for the company to be raising capital where they can right now. Nebius has discussed their cloud platform, which they call Nebius Cloud AI 3.5. It has the name Aether, and it's a tool for AI companies launching faster with less infra management. It seems like this is targeted at the smaller AI startup companies for getting a boost quickly when ramping up their product. On the other side of their business, Nebius said about 50% of their sales come from customers who want bare metal. Lastly, the company announced a 310 megawatt project being built in Finland. And I like that Nebius is building out a global presence for data centers. One stock that I bought and sold in the month is called XTI Imaging, with symbol QTI. I had talked about this stock previously in one of the promising new ideas section of our videos, and I started thinking about how cheap the stock is for a medical devices company. They make scanners for breast cancer with an evolution to a data platform, and recently they relisted back to the NASDAQ, but the share price itself did not recover from its pre-delisting. The share price was about $40 before they delisted, but now that they've uplisted again, the share price is around $6.50. The company just reported earnings recently, with some of their metrics previously pre-announced. The company shipped an impressive 40 scanners in 2025, and that's versus only 12 scanners shipped in 2024. But revenue for the full year of 2025 barely beat their guidance. They had guided for $18 million of revenue, and it came in at $18.9 million of revenue for the full year. This is because sales are planned in advance by distributors, so there may be little upside on the guidance they are giving. One thing in the latest conference call that I didn't like is they have some complex financial arrangements. I didn't understand everything they were talking about, but they have a term loan, different notes, something called cable car notes, warrants, and a few other financial instruments they mentioned. This seemed like a massive rabbit hole of complexity to dive into. The company is not profitable yet either. They had a net loss of $21.1 million for the full year versus negative $9 million in 2024. Ideally, we'd like to see profitability improving as the company is scaling up revenue and gaining efficiencies, but it doesn't seem like that's the case. The company already has 87 scanners contracted for 2026, with a full-year revenue guide of $39 million. This implies $9.75 million per quarter. I did find it impressive that the company is planning to more than double the number of scanners sold in 2026. But as I mentioned, it feels like the revenue numbers and the guidance is pretty fixed here. A large portion of the scanners are going to Middle Eastern countries, and I'm not sure on potential disruptions with the current global conflict. I'm still interested by this company's transition to a data platform and a SaaS offering, as they call it. However, I would like to see some software revenue start landing first to get a better sense of how that part of the business will perform. This stock has incredibly low volume as well, and that gives me concern for building a significant position here. The low volume may be because they recently relisted, and it's not a well-known company. Overall, this does seem like an interesting company to keep an eye on, though. Another company we bought and sold in the month is called FIGS Inc., with symbol FIGS. They make premium medical apparel, and they're expanding to other categories as well. 77% of their revenue comes from scrubwear sold in hospitals, and 81% of sales are in the US, with 19% international sales. The company's never had an acquisition before, and they even rejected a takeover offer in the past. The company's Q4 implied guidance was $164 million by backing out the full year numbers. This number landed at $202 million, which was a huge beat and up 33% year over year, beating the guidance by $38 million. The commentary on the last call said Q4 performance was nothing short of remarkable. Additionally, the company's full-year revenue exceeded their initial guidance by $90 million. The company mentioned Q4 performance included absorbing the impact of tariffs and writing off some older inventory. Adjusted EBITDA in Q4 was $26.7 million, with net income of $18.5 million. They had record net cash of $300 million as well. So the company's already profitable, and it seems like revenue growth is picking up now. The earnings call detailed that the January jobs report showed 130,000 healthcare and social assistance jobs added. Now the product line is expanding to underscrubs, outerwear, lab coats, compression socks, and loungewear. And it seems like the brand has a really strong following from hospital workers. International revenue grew 55% year over year, and they doubled their market reach in 2025 to 58 countries, expecting to get up to over 80 countries soon. There's also a small fleet of retail locations in New York, Houston, and Chicago. However, a few of my concerns include that the 2026 guidance is for only 10 to 12% of revenue growth. Q1 is guided to the lower 20% year-over-year range, and it's a slower season in Q1 than Q4. So I think I'd like to see a big Q1 overperformance again to understand the momentum of this business. The company sources their products from Vietnam and Jordan. Vietnam has a 20% tariff, and Jordan has a 15% tariff currently. Again, this is another company where I'm wondering if shipping from Jordan could be impacted by the global conflict. I'm also not sure if they may have to pay higher rates for shipping due to higher oil prices. So we'll keep an eye on this promising company and see what they deliver in Q1 before reevaluating again. One more company we bought and sold in the month is Sandisk with symbol SNDK. They are a NAND memory maker with increasing profitability. I bought and sold Sandisk last month as well. So this is really a company I've been on the fence for a while now. It's not a must-own stock from my perspective, but there's compelling economics on the business. I was looking to get my number of portfolio companies down to a more reasonable number. The profitability of this business is allowing the company to reduce debt rapidly. A few quarters ago, the company had $2.07 billion of debt. It then went down to $1.56 billion and $0.81 billion in the latest quarter. So it seems like it's only 1 or 2 more quarters before this company is completely debt-free. Rapidly expanding gross margins are expected to reach 67% next quarter. This current quarter revenue landed at $3.03 billion, which was up 51% year over year. Even more impressive is the guidance for next quarter, which ranges from $4.4 billion to $4.8 billion. If the company hits the top end of their guidance range, the growth would be 177% year over year and plus 55% quarter over quarter. A few takeaways from my side is that holding Sandisk has significant overlap with Micron in terms of the product. And I prefer Micron for its wider array of products. Micron also makes high bandwidth memory and DRAM, so they have a more diversified portfolio. However, I do view Sandisk as a very solid company to own for a growth portfolio. The last company that I bought and sold in the month was Applied Optoelectronics, with symbol AAOI. They make optical transceivers being used by hyperscalers in data centers. I ended up FOMOing back into a small starter position after having sold this company at a much lower price. I made a much more detailed video about this company and on the topic of FOMO and tilt in growth investing. My biggest concerns center around that management oversold the potential of the company without acknowledging the risks of scaling up. The company is building a new factory, and they just signed the lease a month ago for this new facility. Another concern I had was that the analysts noted that there's weakness in CATV providers, a key business segment for Applied Optoelectronics. One thing I've been trying to wrap my head around is how the innovation level looks for this company. Gross margin over the last year ranges from 28% to 31%. And the company's not GAAP profitable yet. While competitor Lumentum has 39% margins and is already profitable. One of our top holdings, Credo, has a 69% margin with the innovation of zero flap optics. And Credo says they will outperform commodity optics. Although I did gather from AI that Credo's product line doesn't overlap that much with Lumentum and Applied Optoelectronics as much as I originally thought. But I was asking AI a good amount about the innovation and competition in this field. What I gathered from AI is that Lumentum clearly has more innovation than Applied Optoelectronics, but Applied Optoelectronics is still not commodity optics. I'm still ramping up on my knowledge of optics and the main players in the field and how these product sets are different or maybe overlap in some scenarios. But ultimately, I felt I did not need to own a position in this company, and I'd really like to see them deliver on some of their promises that they made. Then we can reevaluate from there and see if it's a holding that we want to add back to the portfolio. Let's now take a look at a company I sold in the month, which is Dave Inc., with symbol Dave. They're a membership-based neobank, as they call themselves. It was a tough call for myself selling here, as the financials are still impressive on revenue growth and profitability. The company recently presented at the Wolf FinTech Forum. The company projects 2026 revenue growth to be from 25 to 28%, but they did caveat this by saying they always take a pretty conservative approach. So I wasn't too concerned about the guidance that they gave. My main concern really comes from competition. And I had previously thought most of the competition is from the buy now, pay later players, which includes companies like Sezzle, Affirm, and Klarna. However, I was surprised at this conference they called out their main competitors as the Cash App and Chime. Both of those companies are pretty well funded with big budgets. So from my perspective, this is a fairly crowded field in an industry we're not particularly enthusiastic about. However, Dave is showing superior unit economics and profitability versus all competitors. Again, the decision came down to concentrating in my top conviction positions. There's other stocks I would prefer to own. And when I look at companies like FIGR Technology, Reddit, or Ethos Technologies, they basically have no direct competitors. And those companies are more greenfield with a unique solution in the marketplace. But I do think Dave is a fine business to own, and I'm considering taking a position again before their next earnings. After I had already sold Dave, I realized how cheap the company is on a price to earnings ratio. So it was a pretty tough call on this one, and we might reconsider at some point. One company I sold right at the beginning of March was BioHarvest Sciences, with symbol BHST. Their product is plant exosomes for consumer products and manufacturing. And I ended up throwing in the towel on this investment. I like that analogy here of a boxing match where the corner throws in the towel to save the fighter. The stock kept drifting down on no news and low volume. Meanwhile, we were expecting announcements from their manufacturing business, which just never came. Looking back, last September, the company had a special call, and this call gave us high confidence for this exciting idea. They made some really incredible statements on this call, which got us excited for the narrative here. Here's a couple of the mentions they made back then. They said they're seeing some really significant catalysts that we're looking to pull through the pipeline, and we believe we'll see at least one, maybe two catalysts delivered for the business in the CDMO before the end of the year. And they also added we're limited with the announcements because those pharma companies or others, biotech entities, are very careful as they're not wanting to disrupt their existing supply chain, and which is, in some case, we are the replacement of this supply chain. That comment about we are the replacement in the supply chain got me really interested in this company. It made me think their products are critical for some biotech companies. The idea of the company sounded really big as well. They said we're democratizing life-changing compounds from plants that will change the world of health and wellness for hundreds of millions of people, while it's preserving the planet for generations to come. I actually do remember being pretty skeptical of this claim, though. It sounded like they could be hyping up their product a bit, but it also sounded like they really believed in the product as well. On the day we were recording the video on March 31st, BioHarvest released their earnings. And it seems like my hunch was right that they were kind of overhyping things. They said for full year direct-to-consumer revenue, they expect 38 to 42 million. And keeping in mind they're doing 9.5 million of revenue per quarter right now. So basically the direct-to-consumer part of the business is expected to be flat throughout the year. This part was also surprising because they have a new drink mix, and they said they've been promoting with athletes a whole lot, which they expected to take off soon. But on the manufacturing side, they said they expect only 4 to 6 million of manufacturing revenue for full year 2026. The company had mentioned they had 4 significant deals in progress in their manufacturing business. So this seems like a really low number compared to what the company was saying. And since that special call, none of these promises have delivered in the 6 months since announcing that special call details. This company also had a big screw up with their investor relations. On the previous earnings, they pre-announced earnings, but it was hidden within a different press release at the bottom. I ended up trimming my position significantly after that. It's also a really low volume stock, and I learned a lesson that I might not be able to get the price I want on a low volume stock, especially when selling. As I mentioned, the stock was drifting lower over the past months on low volume and wide bid-ask spreads. This was a really disappointing result for myself. I believe what BioHarvest is producing is still a really big idea, but the numbers and delivery from this company have been really disappointing. The last company that I sold in the month was Accelerant Holdings with symbol ARX. They are an exchange for specialty insurance. I found they report a confusing set of metrics that does not prioritize revenue, and I was unclear why the revenue growth rate is dropping off and NRR is going down as well. On the revenue side, back in Q2 of 2026, they reported $219 million of revenue, which is up 68% year over year. Then in Q3, they reported $267 million of revenue, which is up 73% year over year, and a big step up sequentially. However, this Q4 was $248 million of revenue, up only 30% year over year, and down significantly sequentially. The company had pre-reported the $248 million number, but I wanted to see the other metrics as well. The stock had gotten quite cheap in the meantime, so it seemed like the expectations were really low here. NRR landed at 126% in Q4, but that was versus 153% last year, and it seemed like management didn't even bother to explain why this number is going down. Additionally, GAAP net income in the quarter was $1 million versus $21 million last year. It was another spot where I felt that management didn't give a clear explanation. Adjusted EBITDA and adjusted net income are also down from the prior quarter. I wasn't sure if there might be some seasonality though. The company doesn't give revenue guidance, but they guide for exchange written premium, third-party direct, and adjusted EBITDA. Yet all these numbers seem to be guided flat going from Q4 to Q1. The company mentioned they added only 3 risk capital partners, bringing their total to 95. What was confusing was the conference call sounded optimistic, but it doesn't line up with the numbers in the current quarter and with the guidance. I found not prioritizing the revenue metric is bizarre, and I'm still completely unclear why prior quarters were growing about 70% year over year, and that suddenly went down to 30% year over year. This was a fairly straightforward sell from my perspective because we don't want to be confused about our holdings. We need to have confidence in the names in our portfolio. Let's now take a look at some promising new ideas I was researching on the month. The first is Omada Health with symbol OMDA. They are a virtual healthcare provider for weight loss with connected devices and coaching. The company went public recently in June of 2025, and in the latest quarter, revenue was $76 million, which is up 58% year over year. They had net income of $5 million and a gross margin of 71%. The market cap is $730 million, and they have an impressive balance sheet with cash of $222 million and no debt. The stock price is below their IPO debut and down over 50% from all-time highs. I did have some concerns on future competition. For example, there's Hinge Health, which does joints and muscles, with a very similar business model to Omada. And it seems like it could be a fairly straightforward move for Hinge Health to encroach on Omada's business. The guidance for Omada was on the weaker side, but management gave heavy caveats that they're not including what they called extras or upside to their revenue. The next company I took a look at is Bloom Energy with symbol BE. They make fuel cells for data centers, and it acts as energy servers, generating power. The product converts natural gas and hydrogen into electricity without combustion, and Oracle is their first big customer. In the latest quarter, revenue was $778 million, which was up 36% year over year. But on profitability, they had net income of only $1 million. The market cap is currently $37 billion with a big previous run-up. I came really close to starting a position in the month, but there was a couple things that ended up holding me back. The first is rare earth procurement for some of their materials. Their product relies on rare earth metals, some of which are hard to obtain right now. It doesn't seem like it's an issue currently, but it could be if they're scaling up at a rapid rate and they need a lot more of those materials. The other interesting concern is that there's heavy seasonality with this business, and it means we'll see a sequential revenue decline in the next quarter. And right now, I'm not trusting this market to be able to figure out seasonality. Another company I took a look at is called Ciena, with symbol CIEN. They have an optical and a routing platform. It's automation software for telecom, cloud, and enterprise. Their latest quarter had $1.43 billion of revenue, which was up 33% year over year, and they had $150 million of net income. Gross margin landed at 44%, and the market cap for this company is $57 billion. One direct quote was, "Demand is incredibly strong, and there's 3 hyperscalers choosing to use the optical solutions for training." A few encouraging signs for this business is management said they expect price increases to show up in Q3 and Q4. They also said the pluggables aspect of their business is expected to triple year over year. However, I did find the company's guidance to be on the softer side. For the fiscal year, they guided from $5.9 to $6.3 billion of revenue. There's 3 quarters left in the fiscal year, and this implies $1.62 billion quarters on average. Ciena is a stock that's had a really big run-up already, and it seems to be getting a lot of hype from the market right now. Let's take a look at some more promising hardware ideas that I was taking a look at during the month. The first is Fabrinet with symbol FN. They're a pure contract manufacturer for optics and electronics. Their last quarter posted $1.13 billion of revenue, which is up 36% year over year and 16% quarter over quarter. The company got net income of $113 million in the quarter, and it's a market cap of $19.8 billion. Their non-optical communications segment is growing the fastest at 61% year over year and 30% quarter over quarter. High-performance compute solutions are driving growth too. However, there are a number of items that are holding us back from making an investment here. The first is a really low gross margin in a narrow range of 11 to 12% over the past year. The headquarters is in the Cayman Islands with operations in Thailand. And it just seems like this company is low innovation overall. They're really a contract manufacturer, and the price for the business or the stock is quite high right now. The next company I investigated is Dell Technologies with symbol Dell. They're a computer hardware producer with an expanding AI share. In the latest quarter, they had $33.4 billion of revenue, which is up 39% year over year. And in Q4, they had future bookings of $34.1 billion in AI systems alone, while they shipped $9.5 billion of AI systems in Q4. The company gave a pretty strong guide for AI revenue in Q1 with $13 billion. However, for the full year, the company is guiding for $50 billion of AI systems. And that would imply the revenue for AI systems is flat throughout the remainder of 2026. The company has a really easy comp next quarter. They're guiding for $35.2 billion of total revenue at the midpoint, and that's versus $23.3 billion last year. Just hitting their numbers, it would be up 51% year over year in terms of revenue growth. The margins for this business are 20%, but they have a decent 11% net income margin. And I do think Dell benefits a lot from the Supermicro implosion. Supermicro had some export control violations again. And it's likely Dell could take some market share from Supermicro, as the reputation for Supermicro has gone down quite a bit. Let's take a look at a few more promising ideas that I looked at in the month. The first company is called nLIGHT, with symbol LASR. They make something called high-powered fiber lasers, and they had an overperformance in their aerospace and defense segment. The latest quarter's revenue was $81.2 million, which is up 71% year over year and 22% quarter over quarter. But the company isn't profitable yet. They had net income of negative 4.9 million, and the market cap is 3.6 billion. So the stock is fairly expensive right now. They also make a high energy laser and a beam director for the Stryker vehicle. Their solutions are used in counter UAS applications as well. There's a few reasons we aren't investing here though. They recently raised 190 million of capital, so they're not self-sustaining yet. They're also mostly reliant on government contracts. The Q1 guidance was unimpressive as well, where they're guiding from 70 to 76 million, or a sequential decline in revenue. Another company I looked at in the month is called Planet Labs with symbol PL. I first heard about this company from someone on Twitter, and they were asking for my take on this company and their latest earnings. It's always great when we hear about a new stock from someone following the content. This company does daily satellite imagery, and they're a geospatial data provider. They have the largest constellation in history, they say. There's 200 low Earth orbit satellites with complete global coverage at a daily cadence. It's 98% recurring revenue, with a lot of European contracts. One of the contracts the company called out is a 240 million euro contract with Germany and NATO. There's also a 9-figure deal with the Swedish Armed Forces. Additionally, there's a Google deal with a project called Suncatcher, and it's for AI plus solar. But the management did clarify that the Suncatcher program is not really generating much revenue. The company saw a revenue of 86.8 million in the latest quarter, which grew at 41% year over year. But the company is still deeply unprofitable at the GAAP level, and it has a 9.7 billion market cap. Some impressive metrics that were given by the company include remaining performance obligations of 852 million, which is up 106% year over year. They also have a backlog of 900 million that grew 79% year over year. It also sounds like their product is fairly sticky with a 98% recurring revenue. However, I thought the guidance the company gave seemed light. The next quarter was guided from 87 to 91 million, which would be up 34% year over year. That would be a slight tick up from the current quarter. This latest quarter was technically Q4 of 2026 for their fiscal calendar. So they guide for a full year fiscal 2027, and the guidance they gave implied average quarters of 110 million. It seems fairly reasonable, and I would expect this company to be raising guidance throughout the year. The market cap for this company seems quite large already, but it does sound like an exciting product, and we'll keep our eye on this company going forward. Let's take a look at my final thoughts on the month. It was another tough month in investing for myself and for growth investors across the board, but the last day in the month did have some significant share price recovery. And we will likely need to wait for the Q1 2026 earnings reports to see some names go higher in our portfolio. A key takeaway is that the market cannot hold overperforming fundamentals down forever. I'm enthusiastic about a lot of the prospects for the names I own, despite the share prices going down. This concludes our monthly portfolio summary for March of 2026. If you enjoyed the content, leave a like on the video. And any questions or comments are always welcome on the channel. As a last reminder, this is not an investment advice or recommendations to buy stocks. Thanks for listening.